Long-term trading is holding an open trade, position or investment for an extended period of time. There are many ways how you can do it. On this video, I will show you 4 key strategies for long-term trading. The first one is 200-day moving average. It's a very popular indicator which is calculated by an average closing price of the last 200 trading days. So it creates a single line on the chart. And you have few approaches to trade this indicator. First one is when the price is above the moving average, this 200-day moving average. That means that there's an uptrend and you should buy. Of course, when the price is below 200-day moving average, it means that the price is in a downtrend and in general you should sell. Another approach is that you can use this line as a support or a resistance. So when the price is above the moving average and it touches it and then bounces, that's a signal to buy, and when the price is below the moving average, touches it from the bottom and then bounces, then you can sell. You can also use crossings of the moving average, of course. So when the price drops below 200 moving average, it means that you should close your long position and open a short one. When the price goes above 200 moving average, you should buy. Instead of crossing of the price and the moving average, you can use short-term moving average as well. So for example, you trade a cross of 50-day moving average above or below 200 or 15. For example, it depends from the instrument and from the time frame as well. Second one is carry trading, where you can use swaps in your favor. This can be complicated, but all you need to know is that when you trade in the long term, every day, every night, you pay interest. Broker charges you a small amount of money, which is called a swap. Sometimes broker pays you this little amount of money overnight, which means that by holding a trade, holding this position for a long time, you make money just by holding this trade. The exchange rate, so if the price goes up or down, does not matter. How it works? Well, if you buy a currency which has higher interest rate and you sell the currency which has lower, most probably you will have positive swaps. So you will have this additional amount of money on your account every night. If you buy a currency which has lower interest rate and you sell currency which has higher interest rate, you will have to pay this interest overnight. If you hold a position for long enough, like few weeks or a few months, this small amount of money will make a difference. So, for example, you can lose a small amount of money on the exchange rate, but in the long run, you can make money on the carry trade by buying a currency with higher interest rate. Let's talk more about interest rates, this time real interest rates. Real interest rate is a difference between interest rate and inflation. Nowadays, most of the countries have low interest rate but high inflation, which creates a situation that real interest rate is really low. Some traders believe that you should buy currencies with a high real interest rate, which means that currencies with low interest rate and high inflation, so in consequence with a low real interest rate, those currencies should be avoided. So you can sell them and you can buy currencies with high real interest rate. And the last one is PPP, so Purchasing Power Parity. This approach allows you to measure the strength of the currency against the basket of goods. And by using this approach, you get currencies which are undervalued or overvalued. And yes, you got that right. In this approach, in the long term, you try to buy those currencies which seems undervalued and sell those who are overvalued. On this video, I showed you 4 strategies which you can use. As always, you have to do your own research and find which strategy works the best for you. Thanks for watching this video and see you on the next one.